Here's what's going on. The S&P 500 is down 12% the past 2 weeks. The housing market is dead. It's freaking dead. Mortgage demand's at a 22-year low, and you want to raise rates from here. With mortgage rates now surpassing 7%, making housing totally unaffordable, and you're going to continue to raise rates. Apple just said, this is today. Apple just said today, it told suppliers they're not to increase iPhone demand. VF Corp, one of the largest power retailers, today lowered earnings by 15%, saying that back to school was weaker than expected and inventory is surging. DocuSign, today, laying off 9% of its employees. Look at Nucor, a week and a half ago, lowered earnings considerably after reporting record earnings last quarter, saying everything was great. That's how quick this happens. When you raise rates at this pace, where the last two 75 basis point hikes are not even factored in, and you're talking about bringing rates over 4%, we're pricing in 4.5%. We're not pricing them. You want to bring the 4.5% and keep them well above 4% for all of next year. Look at what's happening to the economy right now where rates are. Look at every industrial company. Almost every one of them were warning. Look at FedEx, who lowered and removed guidance. A company has been using AI to track their consumer trends for over 10 years. Basically said, we have no idea what's going to happen over the next 3-6 months or next year. We're removing our guidance. We have no idea because there's no way the Fed can continue to raise rates here. Look at the chemical companies, all of them warning. Look at all the semiconductors who are sitting on a glut of trips 3 to 6 months ago. They were talking about how record high demand, drastically increasing CapEx to build more fab facilities and meet that demand. Demand's gone. It's gone. That's how quick it's gone. Look at copper, lumber, oil. Look at the decreases here. Massive, 30% plus. Look at the FANG names who are all laying off people now, along with 50% of the rest of the companies in the S&P 500 that plan on laying off employees over the next 6 months. Look at the NASDAQ down 30%, S&P down 23%, Germany down 23%, Hang Seng down 26%, France down 20%, Nikkei down 8% this month. The 30-year is now at 4%, highest in 14 years, while the 2-year is above that, which is amazing, 4.2%. And now we have, what do we have? We have our president who literally can't count to 20. And I don't care if you're a Democrat. I don't care if we all know it. Democrats, liberals, Republicans, we all know it, right? The guy's incapable, completely incapable. Actually goes on TV and says, the economy's fine. We're doing great. Everything's cool. Employment's great. Look how low it is. Well, we have 6 million unemployed, which gives us what? 3.7%. We have another 5 million they're not counting that they removed from the workforce that say we're not looking for jobs. If you include those, even half of those, we're going to go well over 5%, which tells you stop raising rates. Please stop raising rates. Please. You have these blinkers on. That is blind. You're just like, we're going to raise rates no matter what. Look at the data, what's going on. I mean, every company is going to be, you're destroying industry by industry. Liquidity has dried up. SPACs are done, which they should be done anyway. IPOs are done. You can't get anything funded in this market. What the hell are they looking at? Think about this, guys. The Fed, everything they've learned for 40 years, this current Fed, right? The chairman, everybody else, what they've learned, right? A bunch of these guys who are all 70 years and older, right? Oh, they all should be retired, go to a yacht, whatever, right? They continue to work, continue to think they understand the economy and people. They believe last year at 5%, with CPI at 5%, which is the highest rate in over 30 years, that it was transitory at 5%. That's what they believed. Okay, this was 9 months ago. Look where we are now. How do you change? How do you not say that it's transitory? Transitory could be 12 months, could be 18 months, but everything you've learned since it's transitory. Now all of a sudden you're raising rates incredibly, and everyone's like, we got to go much, much higher, much to control inflation. You have inflation under control. You did your job. Last year wasn't under control. You said it was transitory at 5%. It went to 9%. You had no idea what you were doing, right? Boom. You should have got fired. You didn't get fired. Fine. It's hard to fire the Fed anyway. You should have lost your job, right? You lose your job at any other being that wrong, you lose your job no matter where you have it. Where your job is, you lose your job for making that call. Now, all of a sudden, total reversal. You're controlling interest rates. They're not out of control. They'll go up or down a little bit. They're starting to go down. Yes, we had a little bit, but they're in control. They're not going from 5% to 9%. They're in control right now. You just have to sit back and wait, and you're raising rates at the fastest pace, at the most it's been raised in 40 years, and you're destroying the consumer. You're destroying the global economy. We're not going to be heading for a recession, Dan. We're going to be heading for a depression. We're going to be in a depression. If you're going to keep rates, raise them over 4% and plan on keeping them for the entire year, we're going to have a depression, not a recession. And that's what's dangerous, because you could slow down the pace, you could relax, and we could see a lot of this filter out, inflation come down, and, they're saying we're not in a recession, right? They're going to redefine the recession. 2 straight quarters of negative GDP. We're going to have 5 out of 6 quarters of negative GDP. That's what we're going to have here. That's how terrible it is right now with the markets. Everybody's saying it. All the companies say this. I just reported stuff for you today that happened. This has been happening for the past 2 months. Little by little, all the companies laying off 20%, 10%, 15% of their employees, more and more and more and more. What do you need to see? Stop looking at a CPI, which was fixed in 1993 to make sure that we'll never have high inflation. This way the government can spend as much fucking money as they can. Stop looking at it. It came back to bite you in the ass because now you have a housing market that's frozen and you have renters now that they can't afford housing. So they're going to rent and they're going to pay up to rent and they're good renters, right? So now you're going to rent. And now you're going to keep this market, which is 30% component of the CPI, which is the number one gauge, the only gauge you look at for inflation. The number one gauge is going to remain relatively high because shelter is such a large component and rentals aren't going down because you froze the housing market. So home prices are coming down. People are going to rent instead of buy, which is going to keep rental prices up, which is going to keep the CPI up. I mean, oil prices crashed last month and the CPI showed a big gain. That's how much rental income is a part of that. And it's going to continue. So what else do you need to see? I don't know. And you know, I'm getting emotional here because they just don't get it at all. They don't even see it. And the only people that see it is outside of their circle. You got Alarion saying, what the hell's going on? You see Drunk Middlesex. You've seen just a lot of the billionaire fund managers and Jeffrey Gundlach. They're all saying, like, there's going to be a disaster, especially for the equity market. It's going to continue to be a disaster as long as you're raising rates. We've never seen an environment that's absolutely crashing industry by industry and you're raising rates. We've never seen that before. What you're telling everyone is remove all the money you have in stocks and equity market because no matter what it is, you're going to get wrecked no matter what sector it is. I mean, look at gold, right? What'd you say about Newmont? Newmont should be a great company. In an inflationary environment, it should be great. It was in our portfolio. We did well on it because we recommended it earlier. We sold out of it. What has Newmont done?
And also, real quick, when you said we were selling that, I thought, what are you, crazy? Why are we selling this? And we did sell at higher prices. That was good for a gain. Newmont was a little over $80 a share in April of this year, and now it's around $40. And it pays a good dividend. It's a solid. It's one of the
earnings are growing.
You hate to use the word safe, but in the world of investing, when you get in the context and the arena of what we're discussing, there is arguably not a better miner set up for the long term. 10 plus. I mean, they give guidance. It's been a little while since we dug into it, Frank, but I believe if I remember back to our recent write-ups or whatever updates, Newmont gives guidance for like 5 years or longer on production. That's to the extent of their mines, their operations, their footprint, their joint ventures. It's incredible. But guess what? That doesn't mean anything because if you've held it over the last 6 months, you've seen it drop, 40, 50%. It's wild. It doesn't have to make sense in the short term. That's again, but to your point, yeah, gold is popping, but hell,
where's
finally.
Gold? Do you know what gold prices are right
16 and change?
16 and change. Here's a company, along with several of the other majors, Barrick and a bunch of others, Equinox, follow this industry a lot. These guys are producing gold for $900 an ounce. And
1661, sorry.
All right, so and 1661
spot right now.
So they're producing whatever they're selling for is a lot. Their margins are incredible. Their margins are incredible right now. There's a company that pays a dividend. These are companies that almost went bankrupt in 2010, 11 when the market crashed because they're all high leverage. Then they all dialed back, cut employees and everything. Yes, you're seeing inflationary pressures, and I get it. So maybe it's costing a little bit more than $1,000. Their margins are incredible. They're generating tons of cash flow. They have a solid, safe dividend. Nobody wants to buy them because it's an equity. And when everything else is getting crushed and you remove it, you're constantly raising, you're taking tons of liquidity out of the market, tons and tons of liquidity out of the market. The liquidity is coming out of the market. People are selling their stocks like crazy. And by the way, you have to look at October being a market where we could actually see a crash. Okay, because the Fed is not going to do anything in October, right? They're going to meet in November. The data is going to be horrific. You're going to have hedge funds where when we sell for capital gains or losses, we have to do it by the end of the year. They have to do it by October 31st. All these funds are sitting on massive, massive losses. So they're going to sell the stocks that are performing the worst. They're going to sell them at their absolute lows, which is going to push them down even lower. So if you're looking at a stock that you think is dirt cheap right now, wait, because it's going to get cheaper. And I love the word cheaper because earnings are coming down considerably. They're going to come down considerably across the board. People are not spending. They're reining in their wallets.